What is up, everybody? Happy Monday morning. Welcome to the Monday Market Update with me, your host, Sean Grapevine, Director of Agent Direct. And I am joined this week, as with almost every week, by the one, the only, the Mac of the rate stack. He has bips for breakfast. He does best efforts with no effort. He's the Baron of Bips, the Lord of the Locks. He's the Sultan of SLAs, the King of collateralized debt. He's the Colossus of credit, the Titan of the 10-year, and he's here celebrating with us his 3 or 4 week wedding anniversary and is clad, as always, in his vest of power, needing only to keep his core warm as he flails expertly about with extremities, locking loans and signing on new lenders at lightning speed. It is the one, the only, the awesome Austin Koenig. How are you today, Austin?
Doing well. Thanks, Sean. I appreciate the illustrious intro as always. Yeah, it's exciting to kind of touch base with a great week ahead of us in terms of like eventfulness, I guess you could say. So I think we should just kind of hop right into it. I mean, we could talk a little bit about last week, but I think the focus is mainly this upcoming week. So
all right, we'll tease everybody with this upcoming week. Let us briefly look backwards, and I think the biggest thing that came out last week was the PCE. Is that right?
Yeah. So the PCE and then kind of just GDP also comes through that. So what is PCE and GDP? PCE obviously is kind of the secondary inflation measure we talk about quite a bit. Is something that the Fed looks at also in tandem with CPI. GDP is our measure of economic growth. And GDP is something that's kind of funny. When GDP comes out, and it actually came out like with less growth than anticipated. But does that really necessarily move markets? It really doesn't move markets usually when GDP data comes out, because a lot of times what you need to be doing is you need to be looking at the forward numbers that go into GDP. Like, GDP is made up of a lot of different things, but it's a fairly overall simple calculation of, what is the economic growth for an economy, right? And, we've seen kind of with the rate hikes start to, come about, we've seen, growth kind of start to stall to an extent. So not as much growth as we wanted, or, hoping for an expanding economy, but that's not what the Fed's trying to do, is have an expanding economy right now.
Right.
So, at the end of the day, we saw 1.1%, quarter over quarter economic growth, a little bit below expectations. And then we had PCE came in at 4.6%, which is, this is also focusing on core, so not thinking about, energy or food prices necessarily, which are a little bit more volatile. But I think we've kind of always seen with even the CPI readings when we're looking at core inflation, is that's the stickiest part, in terms of it's staying kind of elevated, right? So it's, we had last month's PCE reading get revised up slightly.
Okay.
And we're expecting 4.5%. We got 4.6, so not a huge difference.
Right. Yeah.
Month over month.
4.6. I mean, that's low. I mean, it's got to be like one of the lowest, inflation readings in the developed world right now, and like, it keeps going down.
It's definitely it's going down. And at the end of the day, I couldn't give you every single economy, but yeah, we're running with inflation. I wouldn't say this is job well done, Fed. Like the game is over.
Sure.
There's still work to be done, but necessarily, like I think generally we're not seeing it kind of run away from us for whatever reason. It's still just kind of staying in this sticky part right now, where we're seeing about a little bit of a clip of price growth every month, but it's not out of control necessarily. But at the end of the day, this is not going to give credence to the Fed to say, hey, we should cut rates, or we shouldn't hike 25 bips as everyone's expecting. So I think it kind of parlays well into the Fed's meeting this week. We didn't get to hear it from any Fed people last week because they kind of have this blackout period before they meet. So we'll get to hear Jerome Powell grace us with his presence on Wednesday afternoon. Probably the press conference starts around 2:45, 2:30 Eastern Standard Time. And the announcement of like whether rates are hiked or not, it comes out about 2 p.m. Eastern. So Wednesday is going to be an interesting day, I would say. regardless, the Fed's not probably going to do anything that's out of the ordinary. Everyone's expecting 25 bips, but if I think the market's going to be on its hands and it's going to be on like waiting for anything to grab onto that Jerome Powell says.
Sure.
So
So
that's kind of the big thing.
Here's my guess. Everybody is we'll get some wild swing in one direction, and then come Friday at 1 p.m. the 10-year will be at 3.506%, just like it always is. You can take that to the bank. I mean, it's been that way all year. So it sounds like we've got but at this point the Fed has earned the trust. I mean, in a manner of speaking, of like they're going to do what they say they're going to do, right? Like the devil is in the details of this Fed meeting, right? So certainly going to be a 25 bips hike, right? There's no chance of not hiking. I mean, none of the data is pointing to not hiking, and it doesn't really seem. I mean, they know what the consequences of hiking 50 bips would be, right? So there's 0% chance almost of anything but a 25 bips hike. But what the markets really pay attention to in the vacuum created by there not being any uncertainty about the amount of hike is like the wording around it, right? So kind of how they telegraph the next month's meeting. And so that everybody will be sort of on tenterhooks for that, right? Because like that's the big question is are they gonna stop hiking next month? And I think the Fed, it seems like, has tried really hard to make sure that they're telegraphing exactly what they're going to be doing. So it seems like we're going to be getting 80% of that answer probably on Wednesday. Is that your thought as well?
Yeah, I think we'll get some sort of a resemblance of an answer or kind of a hint. That's the tough part about these conferences is, the Fed understands how much their commentary moves markets, or at least they want to understand that. But I don't think they want whipsaws to happen. I think generally there's been a little bit more inkling to the possibility of another hike. But it's not like a majority thinks that. So like pushing a minority into a majority, or kind of killing off that minority think of possibly another hike. That's what moved markets, right? And also just kind of how it interprets the data sets that have been released in the past month or so, and just kind of getting a better grasp and what to look forward to, like in the jobs numbers, like what does Jerome Powell and co want to see on Friday. Friday, we have another non-farm payrolls, or what we call job numbers, get released. And obviously, with Barry, you've kind of, mentioned May 10th a lot. That's obviously the next CPI release that we have, for the month of April. I'm willing to kind of, I would say just listen in and see what happens. And I don't know, if May 10th really moves markets, or, what data we can get or expect to get. It's going to be kind of all over the place, but we're really just going to have to kind of wait and see what we get, and it's going to be a mixed bag. Possibly, it might just be all in one direction, it might be all in the other direction. It's really could be anything. So, kind of buckle up for a volatile week possibly, and it could be a non-volatile week whatsoever. But you have to buckle up because there's a lot for the market to digest this week, and that's how this whole game works. Is the market is real time. Once it gets new things to digest, it digests it very quickly. Sometimes there is indigestion and things can move around, and maybe the next day it reacts to that same reaction it had the day before, but in a completely different way. That's just what you have to be ready to go for this week. So I would be, definitely keeping close. Anything you like, you got to lock it. And
even if you don't like it.
Yeah, exactly. And borrowers who are shopping for, possibly locking it this week, like they have to kind of have those expectations of like things can move around quite a bit. A price today is maybe not the price tomorrow, for better or for worse.
Sure.
Or it can be even 2 hours from now or an hour from now, right?
As we've learned. So all right, well tell me about this. We've let's get some estimates, some predictions on the board here. Assuming we have 25 bips hike this month, and then for the next several months, we sort of believe like there aren't going to be very many hikes. How does that affect, or there will be no hikes, right? No lowering of the federal funds rate, but also no raising, right? It's going to be stuck right where it ends on this Wednesday. What do we think is going to be the result on mortgage rates then? So like, should we expect it to just to sort of solidify right here? If there's a lack of expectation of lowering of the Fed funds rate, do we see a little bit more liquidity get added at some of these higher rate stacks as lenders lose their fear of being refinanced out of it? Like, where do you think that kind of, with the current expectation going forward for the next 3 to 6 months, that the interest, like, does it have a positive effect on interest rates? Does it have a negative effect on interest rates? Should we expect them to just kind of stand pat where they are right now?
I think so. The way I look at it, right, is I think the worst of the worst in terms of mortgage, like the average mortgage rate that you see, especially like on the Freddie Mac, index, right? Like I think the worst that it is behind us. To be perfectly like, just taking a own prediction out of my own thought process, I think we've passed the worst, but in terms of does it get slightly worse from here, it possibly could have. It could. It just depends on expectations that are set. Vice versa, though, I think it could also get better. I don't think we're going to see a monumental move anytime soon. To be perfectly honest with you, I mean we could see a very monumental move. I could be very wrong, but I don't think we see the average mortgage rate sub 6 in an instant. I think it'll take a little bit to get there. I think it could happen over a month, but like think about it like this right now, like the average I think mortgage rate that they're quoting is for Freddie Mac, which is a little different than what you actually see just because you have tons of different profiles to look at, but it's like the high sixes, like so above 6.5, right? So I think generally it could go from there a little bit higher, but I don't think we go all the way down from 6.5 all the way below 6 in an instant just because of a little bit of news. I think there's going to be a little bit of a slower build down, but I could be very wrong. I think generally this is kind of where we're peaking out at to an extent in terms of rates. I think we've kind of come to our terminal Fed fund rate. If not, we're very close to it. And then once we go from there, it's just a matter of how long are we here. I don't like, for example, in premium is going to be tough to and kind of hard to find, I think, for a while. I think it's just a symptom of where we're at because MSRs help with premium. So that's the mortgage servicing right behind these loans. And that's kind of where we've seen the value come into play at the lower ends of the rate stack. We've talked about this in previous catch-up, our Monday calls, right? Like looking at the rate stack, seeing 5.75 of 5.375, 5.25 at some different rate stacks can really be like generously priced because of the MSR value that they're passing through in that rate sheet. That's probably still going to be the theme, and those sort of valuations are continuing to probably stay fairly rich when we have things such as kind of higher for longer talk happen. But if we have volatility way down, I think that'll hurt those sort of value plays. I don't think premium will recover super quickly. That's the problem. I think is premium will take a while to get back.
If we're stuck where we are for so long, and like eventually somebody's gonna, like, there will be some opportunistic investors that think to themselves, well, hey, like, if rates aren't going to go down, then I don't have to be worried about early payoffs as much as I am right now. And don't you think you'll see a couple folks kind of like enter into the market higher on the rate stack and like be willing to risk that early payoff that seems like it's going to be less and less likely every day we go on?
I think that's going to be seen especially with I think we'll get continual offerings on this from our investors, or we'll go seek them out with new investors, is the private label market stepping in. So, what we've seen in the news is, Fannie and Freddie, they don't want to pay for or really make a cheap mortgage for secondary homes or investment homes, right? that's just not what they're doing with their LLPAs, right? And that's not something that's been the recent one. That's last year we've already understood that. I think with kind of a stable rate environment and maybe offering higher rates than what you see in Fannie and Freddie products, I think that's going to come from Wall Street, more likely than not, or maybe some places that want a portfolio product. That's something that our team's constantly looking at and trying to continue to increase. The lenders such as like CMG have had this for a while, but I think it's going to continue to spread to our other lenders because the Wall Street liquidity will probably get greater and that appetite. They can fill a market niche where they're like, these types of people need maybe more premium, or like they don't want all these adjustments.
Sure.
We can actually make a better price for them, even though it's maybe a less efficient market necessarily.
I love it. I love it.
So.
I used to talk trash about the non-QM and private label market, but it really has shown itself to be a super important part of the arrows in our quiver. So, without going on too much longer, we've got the Fed announcement on Wednesday. We've got non-farm payrolls on Friday. We've got CPI on next Thursday, or next Wednesday, I guess. And you and I will be around next Monday to discuss the fallout and everything that happens this week. So appreciate your analysis. And anything we should be on the lookout for you mortgage wise this week? Any new products? Any new lenders?
I don't foresee us announcing any new lenders, but we do have some that we're working on in the background. In terms of onboarding and getting ready for that. I will say one of the things that we're constantly looking at is just filling in some of the non-QM product niches that we've kind of already done with Lensure, but also giving additional options. I will say NewFi, we recently came out with FMBA. NewFi, we've done a lot of business with them. And, Andy's a great resource, great AE to talk to. They just recently are adding their ITIN, ITIN, however you want to say it. Their guidelines up to 85% LTV, which is huge. That's probably the best I've ever seen on an ITIN product. So that's great news. And they're continually working on new products over there at NewFi. They're actually trying to get into Arrive as well. So they'll be like the first sole non-QM lender that we've been signed up with that would be plugged into Arrive. So that would be a big deal. That's not here, coming right around the corner. It takes time to get integrated with that, but it's things that the team has shared with us, and they're a great resource to reach out to for non-QM stuff. So I think just continually we'll be talking about those. I know Rob's talking on the sales meetings here every once in a while, probably at least once a week, touching on products and lenders. So continue to look out for those or watch the replays. I think last week was Change Wholesale, and they have some really bespoke products for Change that are definitely need to be taken advantage of. So cool, definitely rewatch that if you didn't get to see what Rob and Change had to say on that meeting.
Love it. Well, appreciate your time. Let's all go back out there and lock some loans. We'll see you guys next week. Have a great week, everyone.
Thanks.